welcome to another video. I'm excited to jump in today and cover top stock options for the month of June. And just remember, these are examples. Now, quickly before jumping in, if at the end of the video you found value, you learned something, you're gonna go trade some options, I would love it if you could like and subscribe. It'd really help out the channel grow and get exposure and help out that YouTube algorithm, so much appreciated. So now jumping in, let's take a look at Nvidia. I'm sure everyone's heard of Nvidia after the recent run up here from all the way low of 112 almost, all the way currently trading at $395. So a massive bump in the past couple of months. And Nvidia is getting a lot of exposure because of ChatGPT, AI, etc. So I'm going to walk through some option strategies that you could utilize on Nvidia. And remember, these are just examples. You have to do your own research and determine what option strategy and strike prices work best for you. After this big run up, and you can see here looking at this advanced chart in Robinhood, it's pretty oversold. It's the RSI is quite high. It's up here at the top of the Bollinger Bands. So just take that in consideration. It's a little bit more technical, but I want to jump into the options. I want to show you what you could be doing. So I'm going to go with the assumption that Nvidia is not at its peak, but quite high, a little bit oversold. May come down a little bit, may stabilize. So I'm going to trade a call credit spread. So what's going to happen here? So I'm going to go out 22 days. Typically I want to go 30 days for monthly options, but let's just use this as the example. So what you're going to do is you're going to sell a call and then you're going to buy a call. So you're assuming the stock is going to remain neutral or maybe go down potentially with this strategy. So I'm going to sell, I'm going to be a little bit conservative here. Let's go crazy and look at the 450. So I'm going to sell that call. And now I'm going to add a second option, a leg higher. So I'm going to go to 455, buying that call. So effectively what's happening here is I'm going to collect a total credit of $40 today if I execute this trade and it expires worthless in 22 days. So this is really interesting because it's a little bit lower than 10% return in 22 days time frame. So that's pretty solid from an ROI standpoint. But you could also consider that a higher credit is probably more feasible if you choose a lower strike price given the run up Nvidia has had. So the key question is, do you think Nvidia is going to run up all the way to 450, go up another 50 points from where it's currently trading in 22 days? That's what you have to consider and take into account. I'll show you, for example, if you go a little bit lower, a little bit more aggressive and closer to the current strike price, and you set up this call credit spread, you're going to sell one call here, the 425, and then you're going to buy a call a leg higher. So I'm going to go for the 430. So the spread here is 5 points. You're putting up $500 of collateral for this trade. You could collect $90. So by doing this trade, that's almost a 20% return in 22 days if you execute this trade and it expires worthless. So that's the Nvidia example, given everything that's been going on with Gen AI, ChatGPT, etc. So let's go take a look at Shopify. Another interesting chart here with Shopify. Massive run up here, early May. Peak of $65 almost, $64.38. And now it's kind of stabilizing, coming down. And you could see that there's this big gap here between the low 46 and this massive run up to 64. So you could argue that the stock could consolidate, come back down. I'm going to walk through the example, the call credit spread for Shopify. So I'm going to go with the assumption that the stock consolidates. It may go down a little bit. So I'm going to walk through what a call credit spread on Shopify looks like. And I'm going to go out a little bit further. I'm going to go to July 21st, so it's 50 days out. So let's take a look at the option expiring July 21st. I'm going to assume, maybe Shopify will go up a little bit in the next month or so, but I'm going to go with the assumption that it's going to remain neutral, consolidate a little bit. And let's take a look at what happens if we sell this 70 call, and you can see here the delta is 0.17, implied volatility 47, so okay. So if we sell that option, now for the call credit spread, we need to buy an option a leg higher. So I'm going to go buy, and I'm going to choose the 75. So now the spread's 5 points, the amount of collateral at risk is $500, and we're collecting $44. So similar to Nvidia, the return here is about 10% in, 50 days. So you could say the return's a little bit smaller relative to Nvidia in that time frame. It's worth considering, although 10% in 50 days is still pretty phenomenal. So that's the call credit spread example. And now I'm actually going to show one more example of, let's say, a put credit spread. Let's say, you think Shopify may remain neutral, and actually, even though it's jumped up significantly recently, has that forward momentum given the market turning around and tech improving significantly. So let's look at a put credit spread. So what you're going to do here for this example is you're going to have two options, two different strike prices, but both puts. You're going to sell a put, and then you protect yourself a leg lower by buying a put. So let's look at the 45 put, being pretty conservative and far away from where it was currently trading. And we're going to buy a put. Now we're going to choose one leg lower, so the 40. So you can see up here in the top right of Robinhood, you're selling a 45 put and you're buying a 40, a leg lower. So now your total credit, $29, about 30 bucks, putting $500 of collateral, so maybe 6.5% return roughly. So really not bad in 50 days. Again, you just have to consider, where do you think Shopify is going to move, which direction, up or down? Are you bearish or are you bullish? And then you can determine what strategy works best for you, in which strike prices make sense. The next one I'm going to cover is actually UPS, and I'm pretty sure I've covered this in some other videos, but I think this is a great stock to trade cash secured puts on, given the recent movement of it and consolidation around this 165. So looking at the advanced chart, you can kind of see it's pretty oversold. If you go to the 1 month view, the 30 RSI, it's about the 165, and you kind of see it's bottoming here around this 165 point. Again, I'm not a technical expert by any means, but it's really great to look at the charts and understand them and see where the stock's moving. The simple strategy that I'm going to go over is just selling a cash secured put. So this is under the premise that I'd be willing to purchase UPS at whatever strike price I choose for selling a cash secured put. By selling a cash secured put, I'm giving the option buyer the right to put me 100 shares at whatever strike price I am selling. So one thing to note is, to sell a UPS put, you're going to need collateral to cover 100 shares of UPS and to purchase potentially 100 shares of UPS. So if you don't have 16,000, 20,000 worth of capital or margin, I don't advise using margin. I don't personally want to use margin for selling options. Then I wouldn't proceed with trading UPS options, especially selling puts. But for this example, UPS is a dividend payer, significant dividend growth over the past number of years. So personally, that's what I'm looking at when it comes to dividend stocks. What's the dividend growth look like? Is it consistent? What's the payout ratio, etc.? So taking all that into consideration, I'm going to go with this example on UPS. I would sell a put at 165 potentially. So if I do that, that's roughly a 2% return. You would collect $365 today. 2% is amazing in 50 days. If you annualize that, that's a little under 20%. If you want to be a little bit more conservative, and even though, UPS was bottoming around that 165 point, and, you want to purchase UPS at a slightly better value, sell a 155 put, and that's roughly a 1% return by selling a cash secured put and having the option to potentially purchase UPS 10 points lower, 13 points lower than where it's currently trading. That's why I think the UPS stock and selling cash secured puts could be fantastic. And these are some of the examples of prices and strikes that I would look at and the kind of ROIs you could see. The next stock I want to cover for the fourth one is actually Costco. So Costco is definitely fairly expensive. So selling puts, selling calls will be much tougher depending on the amount of collateral you have to trade with. But you can definitely see Costco's been consolidating in this price range, peaking of 550 all the way down here to 450. Going to the advanced chart, it's now consolidating around this 200 moving average, which to me is extremely interesting. I'm more bullish on Costco in the long term. I know retail may be going through some things right now, but Costco is an amazing brand, amazing company. Earnings continue to grow year over year. So I'm going to have a bullish point of view on Costco, and I'm going to show an example of trading a put credit spread on Costco. Again, you may be thinking, I don't have $50,000 to trade on Costco. That's totally fine. With a put credit spread, the amount of capital required is much lower. How would I set this up? So I go to sell and put at the top on Robinhood, change the expiration. I'm going to go 50 days out, again, a little further than I typically would prefer, but you want to sell a put. I'm going to go with the 475, given that's, roughly 30 points lower than where it's currently trading. So I'm going to sell one put, and then I'm going to buy another. So now I'm going to buy the leg lower, So up at the top right, this put credit spread, I'm putting up $500 of collateral, the spread between these two strike prices, and I'm going to collect $45. So again, this is roughly a 10% return in 50 days. Not too bad. And if you look at the price history in the past 30 days, it's kind of hit this threshold, but I think it's been consolidating fairly well around that strike price. So I'm willing to be a little bit more aggressive when it comes to the strike prices and the distance from where it's currently trading. This is a great strategy if you don't have a significant amount of capital, but you're very bullish on Costco, you want to collect some premium, some passive income, a put credit spread can definitely be utilized. Now, Adobe. Adobe is going to be a similar story to Costco. Adobe had this massive run up, in my opinion. It's come down, but still consolidating, moving upwards, and it's been performing pretty well. And I think, in my opinion, I'm a little bullish on it. So I'm going to show you the example of selling a put credit spread for Adobe. So let's take a look at the options here. I'm not going to go as far as 50 days just to kind of see how the premiums change and how they differ. So I have to go to sell, I have to go to put. And so for this last example, let's go to the 400 strike. It's roughly 25 points lower than where it's currently trading. And let's go to sell a put like we have before. Let's go to buy. And now let's buy one leg lower. So here you can see if you did this trade, you would collect $85 today, putting up $500 of collateral. So that's roughly a 15% return in 22 days. That's fairly good from a ROI percentage standpoint, but the one thing I want to consider is Adobe has a likelihood to potentially drop down to 400 but bouncing off of it. So let's reconsider these strike prices, and I'm going to show you an example even more conservative. So I'm going to delete that, go back to selling the put, and let's just go very low and look at the 375, and let's go to buy put, and let's go to the set 370, and here you can see you can collect $31 today by executing this trade. So that's a little less than 5-6%, somewhere around there. Given $500 of collateral, you'd collect 31. Not too bad considering Adobe would have to drop 50 points for this option being at risk of not being successful. So definitely worth noting that that's a fairly decent drop from where it's currently trading, and in my opinion, since it's on this upward bullish momentum, it probably has a high unlikelihood of doing that. So again, please remember, these are all examples. Definitely do your own research and determine what stocks, what option strategies, what strike prices make sense for you and how much collateral you are willing to use to trade these options. If you found value and you learned something in this video, like I said before, if you could like, subscribe, feel free to comment down below, and check out the links in the description down below for some awesome learning resources that I use to learn option trading strategies. I hope you have a great one, and we'll talk to you in the next video.